Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. And today's guest is the chief economist and global strategist at Euro Pacific Asset Management and the host of the Peter Schiff Show. We're going to be talking about gold and his thoughts on the economy. Peter Schiff, great to have you on the show.
Well, thanks, Jesse, for having me on.
Well, I want to start with a year in review of the gold space. Over the course of 2023, what went the way you thought it would? What surprised you, if anything? And how will the events that transpired in the gold markets shape the way that you look at them as we move into 2024?
Well, I've been very bullish on gold for many, many years. And so with all the years of gold failing to live up to its potential, nothing really surprises me anymore with gold. I did expect the price of gold to move higher, and it has moved higher. I just would have expected it to move even higher than it did. And the gold price keeps disappointing to the upside. So, I mean, directionally, yes, gold has been going up. I mean, gold is $2,030, $2,040 an ounce. Not too far off an all-time record high that we set about a month ago. I think we got to 2,135. So gold's been going up. And when I first started speaking publicly about gold on national television, the first time I went on CNBC, gold was 400 and change. So yeah, I mean, it's gone up, but I would have thought it would have been higher. And I still think I'm going to be proven right on how much gold goes up. It's just taking a lot longer to get there. But I think at some point, we're going to make up for a lot of lost ground. I think we're going to see a year where the price of gold moves up, several fold. Whether that's going to be 2024 or 2025 or 2026, nobody knows. But I think it's coming.
Well, you mentioned their gold hitting all-time highs. That excited a lot of people, particularly gold bugs. A lot of analysts thought that once gold reached all-time highs, it would then be off to the races from there. The price, as you mentioned, is traced back down to around the 2000 level, where it sits right now. However, gold does remain very strong when you consider positive real interest rates. Do you think there's a fundamental misunderstanding out there about how gold is supposed to perform in our current economic environment?
Well, there's a lot of fundamental misunderstandings about gold. But yeah, when gold hit that new record high, rather than just continuing to rise, we had a sharp drop. I mean, gold got to 2135, and the next day it was back below 2000, or 2 days later. I think it got down to 19, maybe 75. So it had $150, $160 pullback almost immediately. But it quickly recovered. It didn't, go too far below 2000, and it didn't stay there that long. So, I think that this is now the new support for gold, just around $2,000 an ounce. And that used to be the record high. So the fact that we've now are building support near what used to be massive resistance is a very bullish technical factor. And the fact that gold has held up this well in the face of some big headwinds, and these are headwinds that really shouldn't be there, but it's about perception. And the perception was that rate hikes were going to be very bearish for gold, that rising real interest rates, to the extent that they were real, but the markets believe that should have been bearish for gold. But we've now basically finished the tightening cycle, and gold is still at 2000. So if gold did this well in an environment of rising rates, imagine how much better it's going to do when rates are falling. And the real environment that I think gold is going to flourish in is when inflation is accelerating, but the Fed is not matching that with rate hikes. And that's going to be a big wake-up call for investors, because I think what was, kind of keeping a lid on gold was the belief that the government, the Fed, was going to be vigilant and do whatever it takes to put that inflation genie back in the bottle and bring the rate back down to 2% and keep it there. And that's just a fantasy. That's not going to happen. And the markets haven't come to terms with that. And so in the past, or recent year or so, when worse than expected inflation news would come out, that would be bad for gold, even though it's good for gold because gold's an inflation hedge. And so if inflation's a bigger problem, there should be more demand for a hedge. But the way the markets reacted to the stronger than expected inflation data was just the belief that, okay, this means the Fed's going to have to fight harder to get rid of the inflation. That just means higher for longer. And that would hurt gold, and it would help the dollar. But I think as investors start to realize that higher inflation numbers don't mean the Fed has to fight harder to win. It means the Fed has already lost and inflation has won, because there's a limit to how hard the Fed can fight given how much debt is in the system, especially how much debt the governments have and how much debt the banks are holding. And as much as the Fed would like to see lower inflation, they don't want to see a financial crisis. They don't want to force the U.S. government to default on its obligations. The Fed is very political. And so when it has to pick its poison, it would rather pick inflation than a financial crisis and just a collapse of the banking system and a sovereign debt crisis. So when the markets realize that that's where we're going, I think gold's going to be off to the races.
Well, I want to get your thoughts as well on the potential manipulation of the gold market, because as you said, the price dropped precipitously after hitting all-time highs. This led to a lot of people on Twitter pointing and saying, see, the gold market's manipulated. There's no reason to be in this space. I get those comments a lot on the YouTube channel as well. To what extent, obviously, we saw JP Morgan traders get convicted for spoofing the market. To what extent, if at all, do you think gold is manipulated through paper contracts? And do you see that breaking down if you do believe it is manipulated at the moment?
Well, I mean, first of all, in 2001, the price of gold was under $300 an ounce. And in a 10-year period to 2011, it went up to 1900. So why didn't the manipulation stop that? I mean, how did gold go up so much if there was, people manipulating it? Obviously, it had a big move. Now, it should be even higher now, but that doesn't mean it's because of manipulation that is where it is. But I do think that there's a lot of incentives, obviously, to keep the price of gold down. But there's a lot of big money that is selling gold. I mean, when gold hit a new high, there's a trading adage. I mean, it's not rocket science. Buy low and sell high. And, people took profits or took an opportunity to short. I think there is a lot of hot money that trades gold futures. And, when gold couldn't sustain the breakout, I mean, some selling came in. But we're going to exhaust this selling. I think that part of what's happening here in this bull market is that weaker players are being shaken out of the market. They're being discouraged by some of those sell-offs, and that's kind of what markets do. They try to get rid of a lot of the excess baggage, the dead weight, the weaker hands. They give up. But I think gold is being accumulated by sophisticated investors, by central banks. It's clear that we have a monetary crisis looming in the fiat world, and so people are accumulating gold. Central banks are accumulating gold, and we've had a few false starts And so when gold makes a new high, I think investors are still trained to sell into it, because every time it's made a new high, it's pulled back, and the people who sold made money, and they were able to buy back cheaper. But it's going to work until it stops working. And then I think that once the price of gold, breaks out, let's say we make the new high, let's say we get up to 2150 next time, and then they start to sell it, and they can't bring it down very much because new buying comes in and the price makes a new high. And, and the efforts to sell don't, produce a much lower price. That the buyers coming into the market are just taking up all that, the sales. And then at some point, it's the sellers that are going to throw in the towel. They're going to stop selling. And, when it comes to the paper markets, it's going to work both ways. A lot of people were shorting gold that didn't exist, that they didn't own through the futures market. And so that allowed selling to take place that might not have taken place without the futures market, because how do you sell what you don't own? But futures markets allow you to sell what you don't own. But I think that what ultimately is going to happen with those paper markets is the shorts are going to get caught, because I think once the market really has a big bid and it's hard to buy gold, I think a lot of the longs in the market are going to look to take physical delivery of their gold. And that's going to be a big problem for the shorts, because typically the contracts settle in cash. So the speculators who have shorted gold by selling futures, they never actually have to deliver any of the gold. But behind every gold futures contract, there's an obligation to deliver actual gold if the buyer wants it. But if the buyer doesn't want it, then you don't have to deliver. And generally, the people buying, don't need the gold, don't want the gold. They're just betting on the price. I mean, there are some companies that probably need gold and that have hedged and bought it and do take delivery. And a lot of the people delivering have gold because they're gold producers, and they just sold forward some production to lock in a price. So they're not speculating. But most of the contracts are just traded by speculators who are just betting on the directional movement of gold. They don't have any desire to take physical delivery, and they don't have any physical gold to deliver. But as the supplies start to be constrained, I think some of these buyers of contracts are going to be taking delivery. In fact, there may be investors who want gold who decide to enter the market through the futures market. I'm going to buy these futures, and then I'm going to take delivery. And so what might really surprise the markets is a lot of longs wanting their gold. And then the shorts need to go into the physical market and buy the bars of gold, the 100-ounce bars of gold that they need to satisfy their obligation. But there you have constraint. Where are the bars? Where are you going to get the bars? So that could really push the price up. So some of the selling in the futures market probably slowed down the rise in the price of gold for many, many years, but eventually it's going to reverse. And the futures markets, I think, are going to act to accelerate the rise of the price of gold.
Well, I want to touch on a tweet you made recently regarding inflation. And you said, if you think inflation is bad now, wait until you see how much worse it gets now that the Fed has declared victory in the fight. Plus, CNBC declaring the death of inflation is a great contrarian indicator that it's about to rise like a phoenix from a pile of fake ashes. So I'm wondering, how persistent do you think inflation is going to be moving forward? How bad could it get? What are the implications for both gold and the global economy and markets?
Yeah, well, inflation is here to stay. I mean, it's just going to get worse. The budget deficits now are enormous. We're running up approximately $1 trillion of debt a quarter, not a year, which was still huge, but a quarter. So we're adding about $4 trillion to the national debt, which is now 34 trillion, just under, every year. And so there's just no way to finance that in the private sector. Plus, you have tremendous maturities. I think next year maybe 10 trillion of debt matures, and the government needs to have it, refinanced. They got to find buyers, and the rates will be much higher. So the deficits are going to be rising faster. Plus, more and more people in my generation, the baby boom. I'm one of the younger baby boomers, but a lot of the people every year, more and more baby boomers retire. And that means they start drawing Social Security, more Medicare, and they stop paying the tax revenue. And it's just, the deficits are going to explode as the baby boomer stops paying and starts collecting. So the only way to match the government's expenditures and revenue to fill that gap is by creating inflation. The politicians simply don't have the integrity to level with the public about the fiscal situation. They're not going to tell baby boomers that they can't have their Social Security or their Medicare or their government pensions or all sorts of benefits that have been promised in exchange for years of votes. And they're not going to go to the middle class and upper middle class and say, look, we need to double your taxes. Your income taxes have to double and your payroll taxes have to double because that's how much money we need to make these commitments to your parents and your So it's just not going to happen. And so it's just going to be money printing. It's going to be inflation. That is the way the bills are going to get paid. And so the way Americans are going to pay the bills is watching the value of their savings and their wages destroyed because it's a tax. The government's going to take your purchasing power. Yes, you're going to get your Social Security, you're going to get your Medicare, but it's not going to buy you very much. Your Social Security check is not going to go very far when you take it to the supermarket. Right? And so inflation has one way to go, and that's up. And we're already experiencing the beginning of it, but this is, the tip of the iceberg. I mean, we're, what we just got a taste of it. The people thinking, oh, we're just going to go back to 2% a year. No, we're not. We're going to go back much higher. We're more likely to have 20% inflation than 2%.
Yeah, and on top of what you were saying, there's ideas of universal basic income being floated out there, which would only exacerbate things further as well. The Dow Jones recently hitting all-time highs. You wrote, today the Dow Jones hit a record high, trading above 37K for the first time, but that's priced in dollars. At 18.5 ounces of gold priced in real money, the Dow is still less than half the price it hit in 1999. The Dow is overvalued. I expect the gold price of the Dow to crash. And it's not only the Dow, we're seeing the S&P and the NASDAQ show what appear to be incredible strength on the surface. Are all these broad indices set for a correction and a crash back down to reality in 2024, in your view?
Well, again, it's hard to tell. The reason the markets are rallying is the perception that the Fed is done hiking. So if the Fed were to surprise the markets and start hiking rates again, yeah, the markets are going to get clobbered. But if the Fed follows through with, what everybody feels is coming and we start to get rate cuts, then the markets could continue to rise, along with the decline in rates. But I think that a decline in rates will be accompanied by a big decline in the dollar. And that will mean a big rise in gold. And so I think that the gold price will rise faster than the Dow. And so, yeah, in real terms, stock prices will be falling. But in nominal terms, in dollar terms, they can continue to rise. But they could drop. I mean, if there's a perception out there, if the inflation threat really gets bad enough, and it causes the Fed to do something, then that's going to be very negative for the markets. But to the extent that the Fed just tolerates higher inflation and continues to ease in the face of it, that's going to destroy the dollar. And then gold's just going to go through the roof. And in that scenario, you could actually see a bigger decline in the gold value of the Dow, with gold going way up than you would see if gold and the Dow came down. I mean, if gold and the Dow came down, I would expect the ratio to close because I think that the Dow would come down more than gold. But if we have massive inflation, then I expect both indexes to rise. I just think gold will rise a lot more, which means that the Dow is falling in terms of gold. But I think in an inflationary environment, the Dow could be the strongest of the major indexes. I think that you're going to be worse off in the NASDAQ than you would be in the Dow. Those industrial type companies, or at least those businesses, there's not that many industrials left in the Dow Jones Industrials. But I think it's a better place to be in an inflationary environment than, let's say, the NASDAQ or the S&P. But the best place to be is going to be in neither. You want to be in foreign stocks. You want to be in value. You want to be in inflation hedges, commodity type companies. I mean, you want to be in the strategy that I'm pursuing personally and the strategy that I'm pursuing for my clients at Euro Pacific Asset Management. I think those strategies will perform much better than any US-based equity strategy, and especially the debt strategies. I mean, if you're holding on to fixed income because you think, hey, the Fed's going to cut or the Fed's going to go back to QE, and so I'm going to buy these treasuries that are yielding 4% because they're going to go up in price, and the yield's going to go down to 2% or something like that, you're in for a rude awakening. I think people are just going to be, eviscerated in fixed income because inflation is just going to kill them.
Well, I'd like to touch on your strategy at Euro Pacific Asset Management a little bit later, but first I want to talk about a poll. This poll was conducted in the US of both Democrats and Republicans, and the vast majority thought it was a good idea for the government to implement price controls to try and contain inflation. Now, Republicans were less than Democrats, but still in the majority. This shows a stunning lack of understanding about how the economy works. What hope do the people have when they believe the enemy that caused inflation should also somehow be their savior?
Well, it's not just a misunderstanding of how the economy works. It's just a misunderstanding of inflation and what it is. And that is a deliberate campaign by the government, by academia, and even Wall Street to confuse the public as to the meaning of inflation so they don't recognize the source. But inflation is the expansion of the money supply. That's literally what the word means. If you think about inflation, the root of that is inflate. You can't inflate a price. You can raise a price, you can lower a price, but inflate connotes an expansion. Prices just don't expand. Money supply, on the other hand, does expand. And that's what inflation is referring to, the expansion of the money supply. You inflate it like a balloon, right? It gets bigger as it inflates. Deflation is when the money supply contracts and now the balloon contracts, right? So inflation is like this. Prices go like this, not money supply. Money supply grows and shrinks. But in reaction to that, right, if you inflate the money supply and money has less value, you need more monetary units to buy the same goods and services. The result of that inflation of the money supply is that prices rise. Now, what the government has succeeded in convincing the public is that the increase in price, that's the inflation. And so they've separated the consequence of inflation from inflation. So now that the public has been dumbed down to not understand what inflation is, and they've been told that the result of inflation is in fact inflation, and they think inflation is rising prices, well, then the solution is obvious. Just stop the prices from rising. Pass a law. Make it illegal to raise prices, and voila, inflation is gone. But that doesn't work, because if you make it illegal to raise prices, but you keep creating inflation, you don't magically keep those prices from going up. The market is still going to raise those prices. So the way prices go up when the government controls them is through the black market. So what happens is if the government puts price controls on something, what happens is you can't buy it anymore. because nobody can legally sell it. So let's say the government says, all right, I don't know, let's say apples, are $1 a piece, and the government, and the government says, okay, they've been going up in price, and we're going to have price controls, and they'll say, okay, you can't charge more than $1.50 for an apple. That's the most you can legally charge. Well, if inflation continues and apples should be $2 or $3 or $4 an apple, then you're going to go to the supermarket and there's just going to be no apples, because the price is $1.50, but there's no apples to buy at $1.50. So what do you do if you want an apple? Well, around the alley, there's some guy illegally selling apples on the black market, and he's selling them for $3 or $4 an apple. So, legally the price is $1.50, but if you actually want an apple, you're going to pay $3 or $4. And the problem is, when you have to buy stuff illegally, it's even more expensive, because now the guy selling you the apples, he risks going to jail, right? Selling you those apples. So he's got to charge you even more, because, there's so much risk in what he's doing. He's a criminal. And so whenever the government puts in price controls, it just makes the actual problem worse. And you create the shortages, because if you don't want to buy apples on the black market because you don't want to commit a crime, well, you're just not going to have any apples. And so what good is it that the price of apples isn't going up if you can't have any, right? And this happens all the time. When they put price controls on gasoline, in the 70s, where do you think those long lines came from? That's your trade-off. Yes, gas prices aren't that high, but you got to wait in line 4 hours to get any gas. What's your time worth? Would you rather be able to just drive right up to the gas station and pay, let's say, $5 a gallon? Or do you want to wait in line for 4 hours and pay $2 a gallon or whatever? What is your time worth? Because you're still paying one way, right? You're having to give up working or leisure or something. What generally happens too when there's a shortage like that is the wealthier people pay poor people to wait in line for them. You actually have jobs where people are professional line waiters, and they'll stand in line for somebody who has more money to buy stuff. They have other kind of rationing, or odd even days. But we tried price controls in the 1970s, and of course they didn't work. And one of the ways that companies would get around it, they would have price controls on something, and then they would come up with a brand new product and introduce it. Like they'd come up with a different cut of steak. So let's say there was price controls on a certain cut. They would just make up a whole brand new cut that wasn't subject to the controls, and now all of a sudden they could price it whatever they wanted because it didn't exist before. But so the markets have to get around. One of the ways they got around the wage controls is employers started giving their workers health care as part of their compensation, because it didn't count as a pay raise. They just say, okay, we're going to keep your pay the same, but we'll throw in health care, right? Because that's part of the reason that a lot of people have health care now as part of their employment. It really started as a way to get around the wage controls. But yeah, the markets are going to try to find ways around it. But it's a panacea for politicians. They're all around the world. Politicians are trying to punish pharmaceutical companies. They're trying to punish food companies, utilities. Everybody that's raising prices is getting beaten up by the politicians. Like, how dare you raise prices? You're gouging your customers. You're taking advantage of your customers. They're only raising prices in response to the inflation that those very politicians have created. Right? They're getting mad at the companies for raising prices. The people should be mad at the government for causing the inflation, for reducing the value of their money that caused costs to go up and force these businesses to raise their prices. Otherwise, they can't stay in business, because the businesses themselves are suffering from inflation because all their costs have gone up too. All their raw material costs have gone up. Their labor costs have gone up, right? And so it costs more to produce the goods or provide the services. And so if they don't raise their prices, they're going to go out of business, and then you're going to get nothing, right? So everybody has to raise prices, but the government loves to blame capitalism for the problems they cause. That's the other benefit of dumbing the public down and getting them to believe that inflation is rising prices, because then they can blame the inflation on Putin. They can blame it on greedy businessmen. They don't have to accept responsibility. If the public knew that inflation was the increase in the money supply, well, greedy businessmen can't increase the money supply. Putin can't increase our money supply. Maybe he can increase the supply of rubles, but he can't increase the dollar supply. Only the US government does that, the Federal Reserve. And so if the public understood the definition of inflation, they would know exactly where it comes from. But because they don't, they're susceptible to believe in this nonsense like price controls.
Yes, and these politicians also have a platform where they can go on television and blame the grocery store owners for inflation. The grocery store owner doesn't have a platform to respond and inform the public what's really going on. So that's
Yeah,
very unfortunate.
and they're not happy about raising prices. I mean, they would rather not have to raise prices because their customers prefer lower prices, and you can sell more stuff if you have lower prices. So businesses always want to keep their prices down because they can sell more and they can have more volume and make more money. But when their costs of doing business are going up, they have no choice. They have to maintain their margins so they can stay in business.
You talked about central bank gold buying earlier. I think that's a pretty important development in the gold space. 2022 is a record year. 2023 may be on track to also be a record year of gold accumulation by a lot of central banks across the board. Some people point to the fact of the U.S. freezing or Russian FX reserves as one of the reasons countries around the world started to wake up and realize, okay, maybe the U.S. dollar isn't as safe as we thought it would be. Maybe treasuries aren't as safe as we thought they would be. We need another asset. The more conspiratorial minded point to the fact that, well, the central banks know there's some sort of monetary reset that's going to be coming. You've spoken before about gold potentially being reintroduced into the monetary system. Do you think we're any closer today? We're seeing a bit of a trend of de-dollarization as well, with nations trading in alternative currencies. Um, are you seeing us any closer today towards potentially having gold be reintroduced in one form or another to either the monetary system, international trade, or anything like that?
Yeah, look, I definitely think that every day we get a day closer to gold being reintroduced as money. I mean, it's going to happen. It's inevitable. Gold has been money for thousands of years, and it's been money for thousands of years for a reason, and that reason is that it works. And paper currencies have come and gone, but gold endures. And I think that now, with the technology that we have that makes it so much easier to use gold as money, gold has never been better positioned to serve in that capacity than it is right now. And I think we are very close to a crisis in fiat currencies, a crisis in the US dollar. And so how is that crisis going to be resolved? Where are people going to move? I think they're going to return to gold. There are people that think, well, they'll just go to Bitcoin. And, I think that's a speculation, but I don't think it's actually going to happen. But I think people will go to gold. Now, whether gold will serve as the basis for a cryptocurrency, either a currency issued by governments or currencies issued, competing currencies issued by private companies. But at the end of the day, we will be reintroducing gold into the monetary system. And I think that central banks are going to be replacing their dollar reserves with gold.
Yes, and I think people seem to be so disconnected from the fact that gold is money, but when you really think about it, it wasn't that long ago. 71 was when, Nixon removed the gold backing from the dollar. That was basically yesterday in terms of human history. So I think people will eventually wake up to the fact that gold is money, and it might be a painful lesson to
Yeah,
learn,
and
unfortunately.
it's not like in the Stone Age. I mean, in 1971, we had automobiles, we had airplanes, we had
Right.
telephones, we had televisions. I mean, we were a modern society in 1971. Yeah, I mean, we didn't have smartphones and the internet and stuff like that. But we weren't, in the dark ages. It was a modern way of life, and we had gold as money. And so, it is not a barbaric relic. That was only money, in the caveman days. It was
Yes,
it was money
exactly.
throughout most of human history.
Well, Peter, it's been an amazing conversation. Ton of fun talking to you. Before I do let you go, could you tell us about Euro Pacific Asset Management, what your strategy is there, and where people can find you?
Yeah, and first of all, while we're talking about gold, I do have a gold company called Schiff Gold that bears my name. I started that company, and for people who need to buy some gold and silver, I think again we're near the bottom on gold. I think anything around 2000, I think you're getting in at the low level. Maybe it's not low based on where you could have bought it a few years ago, but based on where it's going to be a few years from now, I think this is a very good entry point. And silver, especially, silver is only about $23, $24. It's about half of its high. It was at $50. In fact, it was at $50 in 1980. So, it's less than half of its 1980 price. There's not that many commodities that you could buy that are half of what they were more than 40 years ago. So silver is very cheap. And we have physical gold and silver that we're selling at Schiff Gold. So you go to the website at schiffgold.com, give us a call, talk to one of the representatives there, and they'll get you in the right metal. As far as Euro Pacific Asset Management goes, I manage portfolios for people. Now, I also manage a family of mutual funds, the Euro Pacific funds. I've got an international dividend payer fund, an international value fund, an emerging market fund, a gold fund, and a foreign bond fund. All these funds can be bought no load. There are investor classes on all the major discount brokerage firm platforms. So anybody can just buy my funds, and I will be managing that for you wherever you have them. Schwab, Fidelity, wherever you have it, I'm managing those funds. If you want to work more closely with me, if you'd prefer to have a separately managed account that owned individual stocks where we pick the stocks and manage the portfolio for you, we do that at Euro Pacific Asset Management. We can customize a portfolio specifically for you, or you can buy one of our already created strategies that's kind of cookie cutter that we're managing for everybody. But we're active managers. We are constantly looking for new ideas and value. And we're not just indexers. We're not passive. We're using our brains to find underpriced stocks and buy them and sell overpriced stocks, not shorting the stocks, but if stocks that we bought cheap become expensive, well, we don't have to keep them. We can take some profits and redeploy the money. And so, our strategies, I think the best environment for my strategies is going to be stagflation, is going to be slow growth to recession, a weak US dollar, high inflation. And these are economic environments that are normally very negative for your typical asset manager. Very bad for stocks, growth stocks, bonds, do poorly in the economic environment that I envision. So, we're doing okay now. I mean, we have decent returns year to date. We're behind the S&P. We crushed the S&P last year. We were actually positive when the S&P was down. This year, we're up quite a bit, but not quite as much. But if we start to see a big drop in the dollar, we start to see a big move up in the price of gold, I think we'll start crushing the S&P again. And so I think this is where people should be. I think inflation is the big risk, and it's going to be a lot higher for a lot longer than people expect. And the portfolios that worked in the 90s and the 2000s and the 2010s, they're not going to work. I mean, they're not going to do well, I don't think, for the balance of this decade and maybe the next decade. I think that this is the 1970s again, but worse as far as I think the ultimate outcome. So what did well in the 70s? Gold stocks, oil stocks, commodities, foreign markets. They boomed while the U.S. market went sideways in nominal terms and got crushed in real terms. But the U.S. market was a great place to be in the 50s and 60s. You had the Nifty 50. It was a big boom. But if you expected the 60s to continue in the 70s, you got killed. And I think the people that are holding on to this bull market's equivalent of that Nifty 50, some of these Nasdaq 100 stocks, some of these key big stocks that everybody owns, I think the returns are going to be horrible, going forward. So you've got to get out of what worked during the bubble, because it won't work as the air comes out of the bubble, and you get to get into the stocks that nobody wanted to own during the bubble. The basic value, real dividend payers, and the commodity type investments. In particular, I think the gold and silver mining stocks are the real hidden gems there, in where you could see just astronomical gains in these stocks. I mean, 5-10 times your money, but maybe 20 times or more. I mean, that's what happened in the 70s. I mean, those kind of gains were there. I mean, there were stocks that went up 50 times, 100 times, some of these small junior mining companies. So I think there's that kind of potential in this market. And we get a real big bull market. We get, $5,000, $10,000, $20,000 gold. And those targets are not out of the question. I mean, I said gold went from 300 to 1900 in the decade from 01 to 2011. Gold went from $35 an ounce in 1970 to 800 in 1980. I mean, think about the magnitude of that increase. And if you look at the Dow gold price, which you mentioned one of my tweets, that the Dow is roughly 18 and a half ounces of gold. Yeah, that's historically high. It's a little lower than it was in 1966 and 1929. But there have been several times where the Dow and gold were close to the same price. Like the most recent was 1980, where the Dow and gold were about 1-to-1. But even if we got to 5-to-1, where would the price of gold be? Well, if the Dow is at, let's say, 40,000, gold has got to be, 8,000 to have a 5-to-1 ratio? It's at, and in order to have a 2-to-1 ratio, if the Dow, let's say the Dow was at 40,000, which is not too far away, for there to be a 2-to-1 ratio between the Dow and gold would have to be 20,000 when the Dow is 40,000. Now, if that happens, you don't make much money in the Dow going from 37,000 to 40,000, but look at what you make in gold going from 2,000 to 40,000. You make 20 times your money in gold. But if you make 20 times your money in gold, you're going to make, 200 times your money in gold mining stocks potentially. So there's just some huge, huge potential. Of course, yeah, there's risk. There's a lot of downside risk. I could be wrong. Gold stocks could get cut in half. They could go more, right? So just depends on, if you're willing to take the risk. But I think that it's a huge, the skew between the upside potential and downside risk. If I'm right about what's going to happen to gold, you can make so much more money than if I'm wrong. Just that you got to be prepared to lose if I'm wrong.
Well, I have so many more questions based on everything you said, especially about gold and silver miners, but we'll have to leave it here for now, Peter. I will put a link to Euro Pacific Asset Management in the description below, as well as the Peter Schiff Show. I recommend people check that out as well. And thank you once again, Peter, for coming on and sharing your knowledge with the audience.
I was just thinking, though, I might have got those numbers. So if gold's at 2,000, it would go to 20,000. That's 10. Yeah, that's 10 times. Because 1-to-1 would be 20 times your rates, 10 times to go from 2,000 to 20,000. I know what I was thinking, but 10 times in the price of gold would translate into, a much bigger gain in the mining stock, especially if it happened fast, right? If gold went up there quickly, the quicker it goes up, obviously, the more that impacts the mining companies, because it impacts their earnings faster, and it impacts the value of their reserves faster.
Absolutely. Well, thank you for that clarification, and look forward to hopefully chatting again in the new year.
Yeah, me too. Have a happy new year and a Merry Christmas.
And thank you for joining us today. As a reminder, this episode is brought to you by moneymetals.com. Use coupon code JesseDay to get a $10 discount on your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.